way banks are operating in this sector, what needs to be done for them to be more involved, more understanding of the same sector? Because as far as I know, there's still a lot of lack of understanding of this sector, which is atypical. We're talking about seasons, we're talking about different expectations when it comes to farming. So please, you're welcome to also give your input, Chitundu.
Okay, thank you very much, Marnix. Good afternoon, and good afternoon to everybody in the room as well. So yes, that is very true. There's very little funding that is going to the agriculture sector. And I think generally it's because the sector is tagged as a high-risk sector. Now, the reason it's tagged as a high-risk sector is because of what you just mentioned. The fact that there's so much volatility and a lot of the crop or livestock production is highly dependent on factors that are directly affecting the sector, like uncontrollable factors actually, like the changes in weather and diseases and so on and so forth. So because of that uncertainty, banks become a bit more averse to lending to that sector. Also issues to do with collateralization. Now, unfortunately, because of the regulatory framework of the lending sector, banks can only go so far lending without collateral. And there's very little collateral that you could use effectively right now for the agriculture sector. Issues to do with agriculture debentures have not yet been widely accepted by financial institutions. Neither are we as financial institutions beginning to treat agriculture products like security. For instance, in other developed economies, we find situations where agricultural commodities are being taken as security. And there's a whole bunch of services and products that are available to the agriculture sector. But then I think there's a lot of opportunity, and we have started heading in that direction as financial institutions to try and deploy more resources to the sector. The government, however, or multilateral stakeholders need to incentivize financial institutions to deploy more capital there. And also financial institutions need to begin to understand that there is need to develop sector-specific products that will react to the agriculture sector. So your regular working capital finance product is not going to work for the agriculture sector, because repayments need to be tagged to a certain timing in the year, and banks don't have that type of tenures either. Perhaps another thing that needs to happen, this is a policy and regulatory issue actually. What needs to be done is for them to tackle issues to do with land ownership and as Cuthbert was talking about earlier, issues to do with KYC, which is know your customer documentation. For land ownership, there's need to formalize that also, so that the farmers, the smallest farmer, can have access to finance through the use of their title deed as collateral. Now that can only be done if there's a deliberate policy by regulators and policymakers to tackle the issue of access to finance, of land ownership. And then also, I think as financial institutions, we need to support the farmers, the agriculture sector by providing appropriate trade finance solutions. So this could be a wide range from warehousing to warehousing, receipt, invoice discounting, and so on and so forth. And also innovative products that meet that particular market. I think I'll stop there for now. Thank you, Marnix.
Chitundu. Yeah, very valid points that you're making. It remains a challenge, obviously. I'm just fishing out one question that I think is very key, which is linked to what you've just said. Yeah, I mean, Christine Smith, she mentions local banks don't support SMEs. Investors will give a minimum of $250,000. But if you are small, you just want to expand and get a loan, it's not equal to that amount. It's probably much smaller. I just need to expand my business, possibility of going international. It's like hitting a brick wall. How is any SME in the food industry supposed to expand their business that way? And here we're talking about the missing middle, right? There's plenty of microfinance institutions around. I won't talk about the high interest rates that are happening, but there is finance. At the same time, there's a lot of there's loans from commercial institutions for large amounts, like the $250,000. But in between, it's much more limited. And then we're talking about that's why Prospero is acting in this missing middle, and we do whatever we can. I mean, we don't have huge amounts of funds, but we're trying to facilitate that. So how to get impact investment to these SMEs in the missing middle? Can I ask Cuthbert to say something about this?
Yeah, I think, thank you very much.
Then you should be able to rejoin the meeting, and then you can select a break after.
Yes, please.
Yeah, that's great. Obviously, I mean, coming from an investor standpoint, I mean, the topic is challenges and opportunities. I always try and also balance what I can call a gloomy picture to opportunities. My experience, you know, obviously sitting on investment committees in East Africa, South Africa, and Zambia, is that I think chaos brings opportunities. For me, that's the way we should look at it. Because if the environment was perfect, then there's no need. There's no problem to solve. So I think we should actually look at these challenges as opportunities for both entrepreneurs and investors. Now, coming to, if I can quickly address what Carl said, which is very important, is that, you know, data analytics, definitely, that's crucial. But coming to your point about investors and where, and I think Christine's point, you see, at the end of it, and I'm glad that the banks are not in this room. I usually fight with them, so I'm glad they're not here today. My sense, let me say this, the stage of your company is really proxy for risk. What I mean by that is that if you're an early stage, if you're a startup, the banks are not the right investment for you. So don't even waste time going there. That's my advice. So you need to understand at what stage your business is at. If it's a startup, early stage, even growth, the banks are not going to touch you. Probably the only reason they invest in you is because you've got a nice house somewhere in New Kasama that they can get hold of if you fail to pay. So you really need to be careful what you're looking at, because you see, as investors, we really take different types of risk. As I said, early stage, you're taking a risk on the product itself or the service. As you grow the business, you're taking risk on best execution risk and business risk. And later on, for growth businesses or mature business, that's where really the banks play. So my advice to entrepreneurs in this room is that I think most of you would fall into the startup early stage category, in which case you should really focus on how you convince impact investors and angel investors to invest in your business. Now, bear in mind what I said earlier. You need to be receptive to whatever type of partnership works for you, including giving up equity in your business. Because you would rather have 10 or 15%. That's if you don't have the cash, because you need to expand. If you don't have the cash and you're willing to dilute to 10, 15%, but somebody else brings in the cash, as well as what we call mentor-driven capital, which is support, I think be receptive to that. And the banks won't do that for you. So in a roundabout way, I'm saying don't touch the bank. That's my view, unless you're a mature business. The banks will come in once you've got these other investors lined up already in the business.
Thanks, Cuthbert. Yeah, don't touch the banks, indeed. Banks can also be very ruthless, if I may say. If you're unable to meet the obligations, there's a risk that they come and claim assets. Yeah, it's probably not worthwhile to engage in loans at this stage, in a growth stage, when you're still relatively small. I'd like to invite the ones representing the companies like Good Nature Agro Call. Also, I'd like to invite after that Laura and Chipokota just to say something about their experience with impact investors, particularly Carl. I understand you have been able to get to attract financing from impact investors. How have you managed? Were there any challenges there? How did you succeed? Just for others to learn.
Yeah, thank you for the question. It's really going to underscore what Cuthbert was just saying as well. Our most recent raise was an equity raise of 2.1 million USD in 2020, which was a huge milestone for us and really helps us get on the path to realizing our long-term strategy. But where I think it might be more useful is to actually to back up a little bit earlier to all of the steps involved in reaching that point and having a mature enough business where that was possible. We started quite small, as I mentioned, and had an advantage that many startups in Zambia don't have, which is the friends and family funding round. Truly, the first 2 years of Good Nature were a mix of friends and family and grants coming from, Prospero didn't exist at the time, but similar organizations and projects that saw value in a $30,000 grant here, a $50,000 grant there, to really help us get on our feet. Some of the challenges that we went through as we tried to formalize and move into the debt space with impact investors were really around spending our time on the wrong things. And a couple of those points I'll touch on briefly. One of your first priorities has to be accounts. From day one of the company, having clean accounts that you can audit. There are all kinds of options and levels of auditors you can engage in Zambia. It really doesn't cost as much as you would think. And if you're one of those organizations that has all the right operational building blocks in place, but haven't gotten there on the account side, you need to make that transition right now. Because it took us about a year longer to transition to formal finance than it should have, just because we weren't prioritizing cleaning up our books and really being prepared for what those investors needed. So that's takeaway number one. Number two for us was, being a social enterprise with both impact and financial goals. In the early years, we really prioritized the impact and put it above everything else, to the point where we were almost operating like a nonprofit. And that also made it more difficult to get formal financing, because when it comes down to it, impact investors, banks, everybody wants to see those financial returns. We really grew in years 3, 4, and 5 based on our revenue growth before finally crossing over into profitability at the end of years 5 and 6. I can't tell you how much more difficult it made it to raise money when we were unable to speak effectively to why our gross margins and net profitability were not growing along with our top line. So being conversant on those topics and adjusting how you operate, even if you're a social enterprise, needs to be a priority for every SME in this room.
Thanks a lot, Carl, for your sharing your experiences. Laura, would you have a similar experience that you can share with us based on your own business or other businesses that you have dealt with?
Malix, I will come in from the perspective of the investors
Sure,
to start
please.
with.
Yeah.
And I think that Carl put it very succinctly, and this is coming from his experience. My experience from working with donor-funded organisations and investors that are investing into that is that if you don't have your accounts in order, you don't have your numbers in order, as in your impact numbers, you're going to find it very difficult to attract any investors. And unfortunately, it's something that does cost money. It doesn't seem to return any money, and everyone's guilty of not paying enough attention to the financials and the systems in place for gathering impact information. So I would agree with Carl wholeheartedly. And also going on to his financial returns, I know that, I mean, I've been involved in trying to make decisions on investment with companies where their financial returns are very thin, and it makes it incredibly difficult to convince investment committees if you are running on losses.
Thanks a lot, Laura. Then over to Chipokota. Of course, Prospero has awarded you with a grant and to support you in your business venture. Of course, Prospero has the anticipation that as you grow with us supporting you in your business, how do you look at the longer term? Will you be ready to attract impact investment capital? Will you be ready for commercial sources of funds? How do you see that? Just looking forward after the grant period.
Okay, thanks, Marnix. I'll speak to that with a bit of more context of my experience with attracting impact investors. Before Prospero, first of all, is the first external investor we've ever had. I was trying to attract external investment into the business even before Cattle Wealth or in other similar ventures for 10 years before it actually worked. So those who might be discouraged that they have applied and it hasn't been successful, I think just keep applying and you will learn, you know, what is required of you or what the impact investor is looking for. And over this time, I think something that I would share is that financial record keeping is very, very critical and important for you to actually show legitimacy that, you know, you're worth investing into and that you will make good of that investment. Also, I don't know who set this standard, but most impact investors are looking to see that you've actually been in the business or doing the work for at least three years or more. So you have to actually earn your stripes. I would like to imagine, or at least what I think that 3 years teaches you is that you've survived, because you have so many challenges when you start a business as a small business or a small to medium scale business. And if you can survive those first 3 years, you can probably survive the next 3 years as well. I think most businesses fold in the first 3 years. So those 3 years, you actually have to do time. So you might be applying to an impact investor. There will be some who will look at, you know, helping startups, but from my experience, is that a lot of them want to see tried and tested businesses. So with the grant that we received from Prospero, which was a post-COVID grant, actually helped us go launch our meat processing side of our business. So Qatar Wealth now has a butchery, a walk-in store, and an online store. Some of you may have seen our billboard on Lunda roundabout, that you can actually order meat like pizza. So you can order meat and it gets delivered to your home anywhere within Lusaka. Are we ready for bigger investment, more commercial investment? Of course we are. We're looking to expand already. One of the things we would like to be considered for with impact investors is actually getting more refrigeration transportation, because now we have wholesale off-takers who we are supplying to, and the bikes that we are using to actually supply this meat to homes, we are having to send out three motorbikes to carry 100 kg of meat to a wholesale off-taker, and you know, all at once, just so that we can get 100 kg of meat to someone who buys wholesale meat from us. So yes, we are, and what we've actually noticed is that once you have one impact investor like Prospero join the road with you to grow as an entrepreneur, or to help you scale up, a lot more investors are interested. So we've had a few others now start talking to us since then. And obviously not everything is attractive, or just because it's money, not all money is good money. So I think that's something else that I would say as entrepreneurs, you want to think about, you know, is it a loan? Is it sustainable? Is it something that you can afford? Can you pay it back based on the terms that are being presented? So yes, investment is needed, but you also have to make sure that it fits in and it suits what you're actually looking for. I hope that answers your question, Marnix.
Yes, very, very elaborate answer that gives us some good insights into your experiences attracting impact investment. So I want to tie in this question that I'm seeing. Working capital. It's a common problem. Working capital. How do you deal with these working capital constraints? Because we all need to procure produce. We buy. Hello? You're welcome. Please mute your microphone. Thank you. So I wanted to invite the Development Bank of Zambia again to talk about this specific issue. Working capital is a key constraint for a lot of SMEs. How do we deal with this? And what does the Development Bank of Zambia do about this? I believe you have some facility to help you in that, and perhaps you can shed some more light on other opportunities that SMEs, also part of this audience, can try and link up with. Please go ahead, Chitundu.
Okay, thank you again, Marnix. Working capital is a very difficult one. I said earlier that financial institutions don't quite understand the agricultural sector just yet. And so financing is very skewed to meet the terms and conditions of other financing options and financing products that they currently have. Now, with regards to working capital constraints, the working capital cycles for a lot of agricultural businesses are quite long. They're quite lengthy. And by standard, the working capital cycle is, for most banks, a working capital facility is not longer than 12 months. Now, for certain types of agriculture activities, that is not sufficient enough, because then you have three stages at which you need working capital, and then the repayment is all the way at the end. I think as financial institutions, we need to learn a bit more about the sector and begin to respond to the sector by engaging in development of products that are very specific to the sector. Now, with regards to the Development Bank of Zambia and how it is responding to this particular issue. So thankfully, we are a government institution, and we're a bit more patient with our capital, though of course it's got to be viable capital. It's got to be a viable, project that is being engaged in. The bank is now trying to ensure that we have products that are very, very specific to the agriculture sector. So we're engaging with our new strategic period. We're planning on engaging in products such as blended financing instruments that are making financing very affordable. We're also doing targeted funding packets, like take for instance a fund specifically for the agriculture sector in response to a certain element of that, say maybe a fund that will directly respond to the agriculture, say maybe crop production in the agriculture sector or livestock production in the agriculture sector. So we're making those strides, and also what we want to do now is with our technical assistance product, we want to partner with other stakeholders and multilateral organizations to try and disseminate information to other financial institutions